Welcome to Dementia Friendly Prince George's County, Maryland Northern Sector webinar series for caregivers. Today's topic is Understanding Social Security, sponsored by Prince George's County Government and the Department of Family Services.
Hello, everyone, and welcome to another dementia-friendly Northern Prince George's County webinar, Understanding Social Security, presented by Michael Hoch from NFP. This event was sponsored by DFA, Prince George's County Government, the Department of Family Services, and the City of Greenbelt, Maryland. Our presenter, Michael Hoch, focuses on financial planning and wealth management with NFP Wealth Team. Michael has 23 years of experience in financial planning, investments, and asset protection strategies. Michael Hoch has worked with NFP's Retirement Plan Services Division for 13 years. Prior to working with NFP, Michael has had his own financial services firm for 10 years in Bethesda. He is also a graduate of the University of Maryland and a native Washingtonian. Michael lives in Gaithersburg with his wife Carrie and 4 children. In his spare time, Michael is an avid runner and 2-time Ironman competitor. Before we get started, a few housekeeping rules, reminders, and disclaimers. All attendees will be on mute during the presentation. Please type your questions in the chat box and we will take them in the order they are received. We will be recording the session and it will appear on the Dementia Friendly YouTube channel for future access. The Q&A portion of this presentation will not be recorded. If you would like to download the handout this evening, they are available on the lower section of the screen. You will also be receiving a satisfaction survey following this session. Please take a few moments to respond. Your feedback is important to the DFA team. Without further ado, I present to you Michael Hoch.
All right. And I appreciate you coming out tonight on what feels like our first real night of fall here after a very nice last couple of days minus the rain. Again, so I appreciate the introduction. My name is Michael Hoch. I am a senior advisor over here with NFP. We are a nationally based independent financial services firm with a national presence locally here. I'm in our Bethesda office and work with individuals and companies helping with investment management, retirement plannings, understanding Social Security, understanding all the nuances of pensions and the ins and outs of everything. So clearly tonight we're going to focus on Social Security. This is a pretty well-packed presentation, and I've done this enough to find that I know folks get eager and anxious and have some questions, and you're welcome to ask them by all means, but I do think if you kind of listen through the presentation, you'll find that I probably will answer the preponderance of individuals' questions, and then clearly if there's any one-off questions, you can send them to us in the chat or I'll provide my contact information subsequent to the call for any conversation or discussions that you might have. So I will kind of get into the presentation. So, basically we're going to, start with, the roots of understanding where Social Security is today, what changes we're going to look like for, 2020 and the future. Understanding, again, as I said, where it stands today, and how you can maximize your Social Security, because it can be a very confusing topic and very oftentimes misunderstood, misguided, etc. So, basically, if we understand, the roots of Social Security, where it came, it was actually started in the Great Depression revealed the vulnerability in society that was basically elderly, could have their savings wiped out with the stock market, and they had no other source for their income. So in 1935, it was actually FDR basically put into place the Social Security Act, which was filed on August 14th, 1935. 1937 is when taxes were first collected from individuals' pay as well as employer. And then in 1940, the first payments were paid out. We have this picture here of Ida Mae Fuller. It's always a good social trivia question, right? So in 1940, she received the very first Social Security check for the amount of $22.54 for her first monthly payment. She retired in 1939, and she started collecting benefits in 1940 at the age of 65. She lived to be 100 years old, dying in 1975. And during her lifetime, she collected a total of $22,000. This is pretty insightful. And at this point, Social Security should have known that there was something flawed within the system. Because clearly back in 1940, right, the life expectancy really was not that long. And clearly she probably never paid in $22,000 to the system, yet she collected, way more than that. Clearly things have been enhanced and things have changed with the Social Security benefits. When we look at Social Security, couple of changes that took place. So cost of living, which is the COLA adjustment, which is an amount that is adjusted each year. It is not a foregone conclusion that it happens. And then the earnings that you are taxed based upon what is your earning maximum that you pay Social Security. And then the full retirement age increase. And I'm going to note one thing here. You'll see full retirement age. And throughout the presentation, sometimes I might say FRA, or you'll see FRA. And that FRA stands for full retirement age. And I'm going to make a distinction because full retirement age is when you are entitled to collect your full amount of Social Security. But you'll see here in the presentation, there are some abilities and options that will increase those benefits. So more benefits for people working retirees, and a higher potential benefit for new retirees. So these are some of the changes that took place in 2020 and what it looks like. So in 2020, the cost of living adjustment is 1.6%. So basically that is for folks who are receiving Social Security, they received a 1.6% increase in their Social Security payment. So if we understand that the average benefit that person receives is about $1,479, next year they would receive an additional $2,400 a month in their Social Security. And I'll show you that this is not always 1.6. Some years it's more, some years it's less. The other aspect to Social Security is what are the maximum earnings that are subject to Social Security. So basically every employee who works pays a percentage of Social Security. So the maximum Social Security wage rate is 6.2%, and then we all pay a Medicare tax of 1.45. So as an employee, you pay from your paycheck 7.65%. That goes to Social Security and Medicare. If you're an employee at a company, do note that your employer pays that same portion for you for a total of 15.3%. If you are self-employed, and I work with a lot of folks who are self-employed, you actually pay taxes on both sides of it. So you pay the full 15.3% on your income up to a maximum of 137. If you are self-employed, please note that sometimes people who are self-employed try and show that they earn less than this wage, and that might be fine, but do understand that when you do that, you will be decreasing your Social Security benefit when you reach your full retirement age. Okay, so when we talk about full retirement, for people who turned 62 in 2020, the full retirement age is now 66 and 8 months. Many people always just were synonymous with, full retirement. Social Security was at age 65. And yes, you can still get that, but you get a reduced benefit. So, for many years it was 65 and it's gradually increased. And again, when we talk about changes in the coming, that is, the idea that they're going to continue to push out the full retirement. So if you were born in 1938, it's 65, and it's scheduled to keep rising to age 67 for any person born after 1960. You can take a reduced benefit of Social Security at age 62, and that is a reduction from your full retirement. And please note that even if you hit your full retirement age, you can push it off until age 70. And if you push it off until age 70, your benefit increases by 8% each year. And that is really something I'm going to stress on and kind of sound like a broken horse here in terms of just broken record, just because I'm going to continue to repeat that. Any year you defer and let it go, your benefit goes up by 8%. And as an investment advisor, financial planner, I like to think I do a good job of helping folks navigate the investment world. But I can tell you, I am hard pressed to tell anyone anywhere that you can get an 8% benefit or 8% return and increase in your benefits. Yet that is what Social Security has to offer. So that's something that, and I'll give some examples of the impact of that. Now, you can earn, so if folks are retired and you, before your full retirement age, before your FRA, if you collect Social Security before that full retirement and you are still working, you can earn up to $18,000 a year and keep all of your Social Security, okay? But if you earn anything over that, you will pay for every $1 in benefit, there will be withheld, you will reduce $1 in benefit for every $2 in earnings over there. So a retiree working who reaches full retirement age, you can earn, at full retirement, you can earn on unlimited. But if you take it earlier, you will and might pay taxes on your Social Security. And therefore, I tell folks when I work with them, really to assess and determine, how, should you take it earlier, right? And we'll kind of go over some of the thoughts that drive that. So the maximum that someone can receive in Social Security benefits right now at full retirement age is about $3,000 per month at your full retirement. If you wait each year after, and it goes up by almost 8% each year, this number goes up to almost $4,000 a month Social Security benefit if you were to delay until age 70. 70 is the maximum at which you would never want to go beyond age 70 when you collect Social Security. Okay, when we start looking at Social Security and the statistics, right? In terms of the numbers, right? 64 million receive benefits. 9 out of 10 people over age 65 receive it. When we start looking at the numbers, 2035 is really the magic number there that people say, the Social Security will not be funded, it will be defunded at that point in time. There's not going to be enough money in there to pay. So clearly at some point, our politicians are going to have to address the Social Security, because initially it was only for retirees. Now we find that it is for disabled, it is for surviving spouses. There are all different types of nuances there. So when we look at the changes, right? So the maximum payout went, again, this is about the 8% increase. In 2019, the cost of living was 2.8%. It reduced to 1.6%. And the taxable income limit, in terms of how much you earn, went from 132 to 137. So they'll tax that higher amount. You'll see the increased, the difference here is if you're single versus if you're married. So if you are single, you can earn, if you take before the full retirement, you can earn up to $18,000. Anything beyond that, you will pay taxes on your Social Security. And then if you're married, you can earn up to $48,000 without paying taxes on your Social Security. One thing that a lot of folks do is to understand is that as of 2018, Social Security only sends paper statements to those age 60. So you can go online, and I tell anyone who ever calls me or has questions is to go and get your statement. And I'll show you what a statement looks like. But you go online to ssa.gov and you can register and get that information. If you were victim to one of the credit fraud, the Equifax and Equitrust, and you were on their list for credit for fraud, you might have your account blocked, and you actually have to go to the Social Security to get it reset. But unfortunately, because of COVID and things like this, most of the Social Security offices are closed. You can go online and you can set up an appointment to speak to someone if you need to do that. All right, so we've kind of stated here that it seems like it's going to be in trouble. Something's going to need to be fixed, and it just it still won't grow enough to do that. When we start understanding Social Security, right? So in 1935, the average life expectancy was age 63. Today, it's age 85. One of the biggest factors that I tell folks when they come to me when we speak is I ask, what is your health? What is your family health history? What are your genes? I mean, a lot of that has to do with some of the decisions that you will make for Social Security. Because I'll show you, if you live, well into your late 70s or 80s, it can be very, very impactful to push out your Social Security. Again, Social Security initially was just covering retired workers. Now it's not only retired workers, but their spouses, survivor benefits, as well as disabilities. And please note, right, initially there were 16 workers for every recipient. Now we have 2 workers for every recipient. So numbers are there. There's quite a disparity that we see within the program itself. Okay, so again, I mentioned this, 2035 is when the funds will be depleted. The revenues will be less than what the benefits are. So clearly they're going to need to be addressed for that, and they will for you. So some of the proposals is to raise the full retirement age, right, FRA. Longevity indexing, so depending upon people how long they live, recalculate the cost of living, increase the payroll cap, folks who are making more to continue to pay it, or to eliminate the cap, reduce benefits for higher income earners, increase the payroll tax. All of these things are out there, and it's just a matter of who and when they're going to address it. It seems right now they just can continue to keep kicking the can down the street. So when we start looking at the net income, right? So this is, so when people talk about retiring, so the earliest you can take Social Security from a retiree is age 62. And the thing that you'll see here is the earlier you take it, the less Social Security you're going to get, and the more you're going to have to rely on your other investments or other assets that you might have outside. And again, I tell folks, right, think about it. If you retire at age 62, and God willing, you live to be 90, right, that's a 30-year time horizon that you need to be able to maintain your life, your lifestyle, and have retirement. Age 66, because the Social Security benefit goes up, the gap gets smaller, and then you'll see at age 70, because of that 8% increase, and the longer the time that individuals have to save, to put in 401ks or 403bs, or save in your thrift savings, or wherever it might be, or put into retirement and reduce some of your debt, you have less of a gap. Years ago, when grandmas and grandpas used to retire, many of them had pensions, Social Security, and savings. So there's this 3-legged stool that was pretty stable. Now pensions are a thing of are few and far between, right? Investments can be volatile. the bank, right? There was a time, 20 years ago, you could go to the bank and get a 7, 8, 9, 10% CD. Now, the banks are yielding nothing. You have no, so you have to put it in the market, and that can become more of a challenge for individuals to understand and to manage throughout that. So if we look historically, at the cost of living adjustments, right? I mean, there were years where it did not. Other years, and you don't rely on this as being the big driver for maintaining cost of living, because the truth of it is, this in all areas, this is less than the cost of living. I mean, we live in the DC area, right? Cost of living in this area, is substantially more than an average of about 1% when you start looking at it here. So long term, does it make a somewhat of an impact? Absolutely, but it's not something that you're going to really be able to count on that you're going to keep pace with inflation from a Social Security benefit. Okay, so understanding Social Security and what you have to do. So you have to have worked and paid into Social Security for at least 10 years or earned 40 credits at 4 credits per year. Your earnings, now do note, when you get your Social Security statement, right, it will actually show you your earnings going back to when you first worked, right? And it's nothing, it's very small. They inflate those and they work based upon current wage and growth. And then they factor in your highest 35 years of earnings, and they're averaged and divided to provide to you the averaged index monthly benefit that you'll receive. And that's the formula. Even if you wait, if you, let's say you retire or you start working part-time, and let's say your income goes down, you are not penalized for that with regard. So if whatever your highest 35 years are, that is what it is. And if you, at age 62, you take a job that's less stressful or whatever it is, and you're earning less, you will not get a reduction in your Social Security benefit. So again, when we talk here, full retirement, right? So for those folks who were born in 43 to 54, yep, 66. And then it scales here, and then anyone born after 1960, it's age 67 is your full retirement benefit. When we start looking at this is what an actual Social Security statement looks like here, right? So you see your earnings, and this is not unrealistic for folks, right? When in 1974, whatever you were earning, and then you started working, but it was, a little bit. And then here you get to age, 2016, that's what your income. So when we look here, right? So if you started at age 62, right, you would receive $1,314. If you went to your full retirement FRA, it's $1,851. And then if you waited until age 70, it's $2,347, right? So that's a difference of almost $600 a month or $7,200 a year if you wait from age, your full retirement to the maximum age 70. And that can be very impactful if you live and have a long life expectancy for yourself. So when we look at these numbers here, right, it's pretty substantial. And again, the thing that I note, if you take it at age 62, right, this is a full reduction. You are guaranteed to reduce that benefit. And it's pretty here, it's $500 a month just here alone, $6,000 a year. But if you factor that out over a 20 or 30 year period, that can be very impactful. So when we talk about, when I speak with individuals and or couples, right, and we start looking at the chances or life expectancy, I think there was a commercial a couple years ago, Prudential, said, what's the oldest person you know? And I always ask people, how old do you people, what's the oldest person you know? Are your parents still alive? I mean, that has a really big impact in terms of that. If there's, if one spouse has higher amount of benefit than the other, and there's a one is healthier than the other. That has a big impact in terms of what you want to do and how each of you individually might elect to take Social Security, right? So, either partner in a couple, here, to live to be 96 has pretty good chances. And that's what we're seeing this day and age. Again, if you start looking at this, if you take an early reduction, it is a 26% reduction in benefit. Right? So that is a permanent reduction. Yet if you wait till age 70, you get a 27% increase in the benefit that you would receive for the rest of your life. So again, the maximum benefit at full retirement age in 2020 is $3,000. So we're just kind of giving an example here of these amounts. So the big question then becomes is, when do you take? So we're going to start doing some of the math here that I'll show you. So this basically just says if you have a full retirement benefit at age 66 and 4 months of $24,000, if you take it early at age 62, your benefit would be $17,600 a year. If you live to age 85, you would have collected $404,000. If you wait each year, you'll see it goes up a little bit. But if you were to get to your full retirement age and receive, we just rounded here, the $23,000 a year, and you live to age 85, it's a difference of almost $41,000 that you would have received just by waiting that time period. Right? And then if that's age 85, if you live beyond that, it's even greater. If you wait until age 70, right? So if you think about it, that's an 8-year period where you didn't collect, but maybe you were still working. And again, if your income, if your salaries were increasing, that part that goes to your highest earnings, right? So it can bump you up considerably even higher. But assuming you live to age 85, right? Now we're talking almost a $61,000 difference that you've collected over those years just by waiting at 70. So I do these and I do these presentations and it all makes sense. And we look at that and, we don't have the crystal ball to know that we're going to live to age 85, but again, you get a good sense of, your health, your family history and longevity and all that. And that helps determine it. But I can't tell you how many times, and I'm so surprised, and there's just the psychological aspect to this, that individuals are like, daggone it, I've paid into this, I want to start getting my money, I don't believe that the government's going to be there and have it for me. And people collect it at age 62 because psychologically they start. But I see this time and time again that it makes sense to wait until age 70 to collect. And then this also has a lot to do with if you're married and or your spouse's benefits, right? So again, we're just going to start looking at it here. Now, if we start going to age 95, right? So same scenario, if you get a monthly payment of this at age 62 and you live to be 95, you would collect $584,000. If you wait until age 66 and live to be 95, now we're talking, $100,000 difference. And then if you waited until age 70, right, and you live to be 95, you would have collected over $775,000, so almost a $200,000 difference. This point here is kind of the crossover point, right? So the break-even point. So the break-even point is if you start at age 66 versus 62, you'd have to live to be age 78 for it to make sense. If you did, break-even point at 70 versus 66 is 82. So those are things you factor in. Now, one of the other aspects that come into play, and this is just for individual, right? Now, the thing to note is a spouse, right, husband or wife, any married couple, right, can take a portion of his or her benefit and or get the greater of the spouse's benefit. So if you take an early election at age 62, you would, and you would only get 32% of the spouse's benefit. If you wait till full retirement age, you would actually get 50%. So if you do take it early, you get a permanent reduction on the spousal. The maximum is of spousal benefit is 50% of the spouse's benefit. So at full retirement or later, it's 50% of the spouse's. But the thing to note for couples, right, is if, let's say you have one spouse who is really the worker and the other who is the breadwinner, and the other maybe stayed at home and doesn't have much of Social Security. If you both reach full retirement, the working spouse will collect 100% of his or her benefit. The non-working spouse can get a maximum of 50% of their spouses. But then what happens is if one of them passes away, you lose one of the benefits, and then you can only get the greater of the two benefits. And I'll go through this a little bit more in terms of how that works. So when we start looking at this here, right? So if you take it early, you'd receive $700, and at full retirement, again, it's $1,000. So it's 50% of whatever the benefit. We're assuming that the full retirement is $2,000. So again, it's 50% for the survivor, or for the spouse. When we start looking here, these are the reductions, the full retirement spousal benefits. So there is a reduction, a permanent reduction you would get unless you wait until age 66 at full retirement age. Before December 15th, you could do a restricted application. And if you were a 62 or older at that year, you could use the restricted strategy that you would kind of file and suspend. This is no longer available to you, so that you can't do that. That's something that, again, years ago you were able to do that. You can no longer do that. So the thing to understand is what happened in terms of maximizing survivor benefits. At death, the surviving spouse will receive the greater of their own benefit or the spouse's benefits. If you do early benefit elections, those benefits are reduced for both lives. The fatal flaw and mistake I sometimes come across is that if you do have a spouse who is working in a higher income, and you can afford to defer and wait, the idea is you want to do that, because if he or she passes away, and let's say you don't have a lot of other assets, that Social Security will be very impactful. Yet if you take it early, it's a permanent reduction, and then you not only does the spouse lose their spouse, but they lose their benefit, and they're getting a reduced benefit on their deceased spouse because they took it earlier. Again, when we talk about survivor benefits, if you take it early, if you take it early at age 60, this is survivor benefits, 71% of the benefit. If you wait till age 62, it's 80, and then the full survivor benefits at age 66 is 100% of their surviving spouse. So again, it can be very impactful as to when you want to take the benefits. If you are divorced, you had to have been married at least 10 years. So if you were married 10 years, you can collect benefit on your spouse, even if he or she is remarried, doesn't matter. But you cannot be, and you have to be unmarried at this point. So if you were divorced and you got remarried and your current spouse earns less than your ex, you can't collect on the ex. So it's you have to be divorced and unmarried, and you had to be at least divorced for 2 years. You need to be at least 62 to receive the spousal benefits, or age 60 to receive a survivor benefit. And the ex-spouse must be at least 62 and have worked 40 quarters to receive a spousal benefit. Even if the ex-spouse remarried, and you don't, doesn't matter. You can still be entitled to collect those benefits. Same thing. And you see the common theme here is the earlier you take it, the reduction that you get is permanent. That's, if there's one theme that we kind of reiterate time and time again, it's that, is to understand, do you have 401k assets, right? So when folks come to me and they ask, how does this all work? The general rule of thumb is if you have a 401k or retirement plan, you want to live on about 5%. Easy rule, easy math. It's usually less, but just for easy math's sake, is 5%, right? So think about it. If you've got $500,000 saved in your retirement plan and you live on 5% of that, that's $25,000 a year. Call it $2,000 a month. Plus your Social Security. I kind of rhetorically say, is that enough, right? But the dilemma, right, is when you put money in the stock market, you can have the ups and downs of the market that you have to be wary of. Whereas with Social Security, right, each year if you're full retirement and you wait till age 70, that benefit goes up by 8% and can be very impactful to you down the road. So again, the factors, you need to consider when how much income do you need? What's your health? Longevity. Right? I mean, I see this time and time again. I'm just doing a review with someone the other day, and she's 70 years old, and we're doing the meeting, and her mother calls, and her mother's like 94 years old, right? So that tells me there's longevity. So you have to plan that and understand how that's going to play into your long-term plan. I always, quote, and most people don't plan to fail. Most people fail to plan with regards to your finances, and that's something that we can help you with. You married, how does the spousal benefits work? How do they look? And if there's an age difference between spouses, this can be very important to understand in terms of Social Security for the surviving spouse, if it comes down to that. The greater the age, the longer the benefit period, and the bigger impact when making an early election. Again, so this goes back to saying the longer you can wait. Again, Social Security has stacked it to say if you defer and you wait, it is going to make sense. If anyone on the call has gone in and elected Social Security, you do have the ability to do a one-time, what we call oops or do-over. You can do that within 12 months. You will have to pay back any of the benefits you received over the last, since you made that election. But I've had a couple of people here make those decisions as a result of this, to understand that. So, excuse me, it's just a form that you would fill out. So when we talk about your taxable, kind of just going back here, if your income, for joint or single filers is less than 25 or 32, you don't pay any taxes on Social Security. If it's between 30 and 44, for joint and single, you can pay up to 50% on your Social Security. And then if you earn more than 34 for single or joint filers, again, up to 8. The thing that I want to note, you don't pay 85% of taxes. It's 85% of your Social Security benefit is taxable at your relative tax bracket. Understand it. When you see the 85%, don't think you're going to pay taxes on that. So I'm going to walk through a couple of scenarios here that I think is important to understand. So if at age 62 you take early benefits, let's say their Social Security was $20,000, they had $40,000 of benefit, so over $21,000 over the limit. So they would actually have only received about $9,000 of Social Security at that point in time. So a total income of 49. Versus if they waited until age 66, right? Their Social Security is this, their earned income is 40, they have no taxes on their Social Security, so they actually receive the full amount. So if you take it early, right? So again, my point being here is, yes, it's enticing to take it early, but you pay taxes on it. So you're actually getting a reduced. So again, we established you're taking it early, you're getting a permanent reduction, and you're paying taxes on it if your income's over a certain amount, right? And that reduction in your Social Security is permanent versus if you wait, you can earn as much as you want at full retirement and not pay taxes on the Social Security. Again, so if for benefits beginning the year, full retirement, any earnings from January, the year you reach full retirement prior, are less than the earnings limit, then the benefits will be paid for the prior full retirement. So this just says if Samantha reached full retirement in April and her earnings are less than the $48,000 from January to March, she's able to receive the benefits in January, and they can be reduced depending upon your age. Again, this is where we talk about, an example of a husband and wife, both age 60. Ruth stayed at home, did not really have much of Social Security. So here we talk, Harry's full retirement at FRA is $2,000 a month. So now we're going to say Harry files early, so he gets $1,500. His reduced benefit is this. Ruth gets half of, 35% of Harry's, so a total of $700 a month. Harry dies at age 75, so then Ruth will then collect 100% of his benefit, yet lose all of hers. In this scenario, if Ruth dies at age 88, she would have collected a total of $351,000 over her lifetime when you combine what they both collected and well as his. If we wait until age 66, right? So he would collect $2,000, she would collect 50% of his, or $1,000. When he passes away, she'd collect $2,000, and if she died at age 88, she would have collected different, $432,000, right? So 432 versus 351, pretty substantial in terms of how much she would have collected over those years. I did the scenario again, the other one, I need to update this, that if they waited until age 70, this number then jumps up to over $500,000 that she would have collected if they waited until age 70. But again, a lot of it has to do with what are your assets, how much money do you have elsewhere, do you have pensions or whatever else might factor into it. So I think the idea here is we wanted to give you guys enough information to kind of ask some questions, and hopefully provide to be helpful. Will your coordination, some considerations. Are you planning on working? Will they be coordinated with your spouse? Have you planned, how the different distributions? Do you have a strategy in place? Are you taking advantage of a Roth IRA where you won't, in earlier years, if you're continuing to work and you take money out of a Roth, that doesn't count as income. So that can be a strategy for you there. So when we talk about, you can collect Social Security if you're disabled, for an average monthly benefit. So collecting disability Social Security is very difficult, and it's not an easy process to go through. One thing to note is if you are of Social Security age and you have a child who is under the age of 18, that you can actually, the child can collect Social Security up until age 18 or 19 if they're a full-time student in high school. Beyond that, they will not collect anymore. So I think, this just talks, some different scenarios. My wife of 2 years, 62, still working. Her first husband died at age 49. She's able to collect survivor benefits, work with her own. So the answer, she should apply for survivor benefits, which don't increase, and then file for her own benefits when she retires. So all of these things kind of factor in, and are very various nuances to look at relative to what your situation is. I think we've got all the information there. I think, oh, here we go. So if you have any questions for me, here is my contact information, michael.hoch@nfp.com. There's my office phone number. I am, as I said early on, a local native Washingtonian. Actually, I've got 2 students at the University of Maryland right now. See how much longer that lasts. But I do appreciate your time. Hopefully you found this to be helpful and somewhat informative for you. And again, if you have any questions, please feel free to reach out to me. If you want to understand this in totality of your different IRAs, 401ks, asset allocation, however it all might work, I'm happy to provide some guidance for you.
And Michael, if you could just go back to the DFA slides. Thank you everyone for joining us tonight. Just wanting to go over some additional information. So we do have our upcoming memory screening Mondays. They take place the first Monday of each month from 2 p.m. to 4 p.m. You can schedule them with Sharon Johnson. Her information is located at the bottom of this slide. We also have our virtual support groups that are still going on the first and third Wednesday of the month from 6 to 7. If you know someone who's interested in getting more involved or seeking support, again, you can contact Sharon by email or phone call. We also do a monthly email newsletter. This includes upcoming resources of virtual events, DFA updates, and much more. And again, this video, as well as past recordings of our webinars, are located on our YouTube channel. This provides educational videos on topics such as being a dementia friend, caregiving, and more. And then an upcoming event that I wanted to mention that may be of interest to you, we are hosting Holiday Ageless Grace demonstration by Karen Hazley, December 10th at 7. It's a live webinar on cutting edge brain fitness program based on neuroplasticity that activates all functions of the brain needed for lifelong optimal functioning. So again, at the bottom, that's Sharon's information if you have any questions about upcoming events, groups, or would like to schedule memory screening. Next slide. And then additional resources for Prince George's County residents. There's the Area Agency on Aging phone number. You can find community programs through them, local aging and disability resource center. You can also go on their website, eldercare.gov. National Institutes of Health, National Institute on Aging, clinical trials if you're interested in seeking other treatments for your loved one, want to hear more about what's going on with treatments that are being developed. And then we also have the Centers for Disease Control and Prevention, information about aging and information on how to stay active. Next slide. And again, thank you, Michael, for such a thorough presentation. I hope our audience also thought so. This is very important information as we enter retirement age, or even if you're planning early. So we don't plan to fail. People fail to plan, so it's always important for you to be ahead of the game. And again, thank you everyone for coming. Please be on the lookout for our next event.